While the retail market focused on daily index volatility, institutional capital quietly triggered a massive structural shift today. A surprise cooling in the latest inflation print has sent yields lower, sparking a powerful capital rotation across the Dow. At the exact same time, ASML stunned the market with a resilient earnings report, sending its stock surging and igniting a broad technology rally. The intersection of easing macro pressure and strong semiconductor earnings suggests that smart money is aggressively positioning for the next phase of the business cycle. To understand why this move matters, we have to look closely at ASML. This company possesses one of the most impenetrable monopolies in the entire global economy. They are the sole providers of extreme ultraviolet, or EUV, lithography systems. Without these machines, fabricating next-generation microchips is physically impossible. When companies like NVIDIA or TSMC want to scale their production to meet high-performance computing demands, they have no choice but to wait in line for ASML's massive systems. But that is only part of the story. ASML's value proposition is deeply embedded in its long-term service agreements and software optimizations. This creates an incredibly sticky ecosystem. Once a chip foundry integrates an ASML system into their cleanroom, they are locked into decades of high-margin servicing and upgrades. This dynamic transforms a traditionally cyclical hardware business into a highly predictable, recurring cash flow engine that few hardware manufacturers can ever replicate. Here's where the margin metrics become interesting. ASML's latest quarterly numbers revealed a substantial stabilization in bookings and system shipments. Even though the semiconductor sector has gone through a prolonged post-pandemic inventory digestion phase, ASML managed to deliver gross margins that exceeded the upper bound of consensus expectations. This resilient pricing power demonstrates that even in a transition year, their advanced product mix continues to command premium pricing from global foundries. Something important is happening here. When we look at the breakdown of net system bookings, a significant portion of demand is being driven by the transition to advanced nodes. Foundries are not just buying standard machinery, they are actively preparing for the integration of high-end EUV tools. This forward-looking booking pattern tells us that while trailing hardware sales may appear flat, the future revenue pipeline is rapidly expanding as leading chipmakers race to secure early capacity. The next signal comes from management's capital allocation and execution strategy. Leadership has consistently characterized this period as a preparation phase for a highly anticipated cyclical upturn. Instead of cutting back on research and development during the industry downturn, they have aggressively invested in scaling their manufacturing capacity in Europe. This counter-cyclical capital expenditure ensures they can meet the massive wave of demand expected to hit the industry by next year. This aggressive execution is backed by clear guidance. Management has reiterated their long-term growth targets, expressing high confidence in their performance outlook. They are returning substantial capital to shareholders through a combination of growing dividends and ongoing share buyback programs. For institutional investors, this capital discipline proves that ASML's management is focused on driving shareholder yield, even while managing the heavy capital requirements of advanced hardware production. Now look at how the broader sector is reacting to the macro environment. Today's surprise inflation cooling has significantly shifted the interest rate outlook. When inflation pressure eases, long-duration growth assets become highly attractive to institutional portfolios. This shift has initiated a noticeable rotation out of defensive sectors and back into secular growth leaders. As global bond yields adjust to a more favorable policy path, the cost of capital for massive semiconductor infrastructure projects is set to decline. This macro relief coincides with an unprecedented wave of cloud and artificial intelligence infrastructure spending. Hyperscalers like Microsoft are pouring tens of billions of dollars into AI data centers. To support this cloud build-out, advanced chip manufacturers must continuously upgrade their manufacturing lines. ASML sits at the absolute beginning of this capital expenditure chain. Any dollar spent on AI hardware eventually flows directly into a foundry's purchase order for lithography equipment. That leads us to a bigger question regarding terminal risk. The primary threat to this thesis is not technological obsolescence, but intense geopolitical tension. Governments worldwide are increasingly viewing semiconductor manufacturing as a matter of national security. Tightening export controls have restricted ASML's ability to ship their highly advanced lithography systems to key manufacturing hubs. This regulatory friction limits their addressable market and introduces localized revenue volatility that investors cannot ignore. The next signal comes from supply chain vulnerability. Building an EUV system requires thousands of highly specialized components sourced from a fragile, single-source network across the globe. A delay in a single critical optical component can stall the assembly of a multi-million-dollar machine. This concentration of supply chain risk means that any local manufacturing disruption could immediately delay ASML's revenue recognition and compress short-term operating margins. Despite these challenges, the forward outlook remains incredibly robust. As we look toward the next fiscal years, the structural demand for sub-3 nanometer chips is projected to grow exponentially. ASML has high forward earnings visibility because of its massive multi-year order backlog. Foundries are locked into multi-year expansion plans, ensuring that ASML's production capacity is virtually sold out well into the future, insulating them from short-term macroeconomic shocks. This earnings visibility warrants a thorough valuation reassessment. While ASML trading multiples often appear elevated compared to the broader industrial tech sector, their unique market position justifies a premium valuation. When you adjust their multiple for the secular growth rate of high-performance computing, the asset begins to look highly insulated. We are looking at a business model that is structurally designed to capture the economics of the entire global technology layer. Let's summarize our tactical review. We are officially placing ASML on a breakout watch. The cooling inflation macro backdrop combined with strong booking momentum indicates that the stock is consolidating with significant positive volatility expansion. Meanwhile, we are maintaining a highly selective approach across the broader tech sector, watching for any localized trim consideration flags in companies that do not possess the same structural moat and pricing power as ASML. As this macro rotation continues to play out, staying ahead of structural market shifts is key to compounding capital. Make sure to subscribe to SR Money News to stay updated with our institutional-grade analyses. Let us know in the comments below if you think the market is underestimating the structural demand for extreme lithography, or if geopolitical risks will limit this expansion. We will see you in the next deep dive.